taking profits on the bearish ETFs, why the Aussie market might fall more than the US from here, and how to build a portfolio for the next rally. Good morning, Gary. How are you?
Yeah, I'm great, Chris. How you going?
I'm pretty excited about this report because it's an understanding of how and why you're constructing the portfolio in a different way when the next fall comes. So what you're getting ready for in the coming weeks is the market to drop a bit more, why that's happening, and then also kind of how and why you're building that portfolio a little bit differently than before. So we should probably start off with the behavior of the markets and the targets that you've been looking at. Now, you've taken profits on your bearish ETFs like the short NASDAQ. Are there any changes?
So I've just cut them in. Yeah, I've just cut them in half actually. So I think I've had like an 18% weighting there on the short side. So I've just cut, 2 positions out of the 4 there, I guess you'd sort of say. So I still think we'll see slightly lower levels, but we saw a bit of a panic there yesterday, pretty deep, almost a retest of the low for the Aussie market and a retest of the low for the US markets as well. So pretty close there. So I'm just looking for CC, slight new low here. So whether that might be 3% or 5% lower than the previous low. I don't think it's going to go that much further, Chris. I just think it'll go a little bit further. So we're getting pretty close here. You might even see a bounce off that low first and then the final crunch, So I just thought it was a good opportunity to sort of lock in some of those profits there. But, we should have now got to start looking at the long side here, start sort of weighing it up here because we're getting pretty close here. I think, sort of the next 1 or 2 weeks here, I think we'll probably see that low. And then, then I think we're going to see something which no one's going to fully comprehend. We might see a bull market which bounce so strongly that no one sees it coming. It's funny. I was sort of trying to work out, been looking at this the last few weeks, trying to go through all the cycles, look through the similar markets there. And the one thing I sort of found was pretty interesting there was something I'll cover here in this report. But let's before I get ahead of myself, we just look at the US market there. I mean, the NASDAQ. So look, right on schedule, pretty impulsive move. I don't think this is going to go all the way out to the end of October. I think it's going to be early October low here. So we just want to see it overshoot the last low, and then we're looking for sort of signs of low. So something back to that old low around 10,000 would be perfect. So that's what we're looking for on the NASDAQ. Interesting, so
The common thing that I'm noticing on these charts is this sort of 2020 high. Is that kind of where this target area is coming from, or this maybe a bit higher?
Well, I just sort of squared a few ranges out as well. So I start to square a few ranges out to give myself a few targets to watch for. Some technical levels, some ranges. So just I'll be watching that pretty closely around that area. Interesting yesterday, Chris, on our market. You see what sector was up yesterday?
You can tell us, what was it?
It was actually the technology. So the tech sector was actually one of the strongest performing on our market yesterday.
Which makes us scratch our heads, right? Because that's been the growth. We've got the NASDAQ chart here. That was the tech that was roaring up here. And it's been torched on the way down. You were talking about was it the 50-80 rule? And
all the stocks have come off pretty hard. So this is a bit of a growth crunch here. But so now we're going to start to look for who's going to outperform here, who's going to hold up the strongest here into the low here. So I thought it was very interesting yesterday that commodities got crunched and technology stocks were actually performing pretty well. So, but won't get ahead of myself. Just again, that was just interesting sort of price action yesterday. But we'll go to the next chart there, the S&P500. So pretty similar there to the NASDAQ. Should go slightly lower. It's obviously gotten pretty close here. The main thing there is that this leg's been pretty impulsive so far. So it's been pretty aggressive selling. It's gone down quickly. So again, I don't think this is going to run out to the end of October. I think this is going to find a low, sort of harder and sharper. And again, if we come back to that 3-4, back to the old low, would be perfect. Or maybe the 50% of the range there around 3-5. Those somewhere around that mark would be perfect there. Again, I think that's going to be in the next week or two rather than the end of next month. So yeah, this is following the more bearish sort of cycle, which will be a shorter cycle. So yeah, so we're just going to watching those levels. So yeah, interesting. We're sort of hopefully we might get a little bounce here for a couple of days off the last low. Just, you know, people tend to sort of go back to the old support and double bottoms and that sort of stuff, which is one of the worst success rates of any trade. But doesn't stop some people trying to buy them. So but you might get a little bounce there, and then we get them. Then it basically finals, you know. But I don't think it'll rally more than 2 or 3 days. If we get any little bounce here, it'll bounce for a couple of days, and then it'll go back down again. But I think we'll see a new low here in the next couple of weeks, and then yeah, hopefully that'll that should be the low.
So that's the NASDAQ, sorry, the S&P 500. The Aussies, this is where it kind of gets a bit different and interesting. Now, obviously, we trade the Aussie market, so we're looking at Aussie shares all the time. And throughout this period here, we were kind of expecting the Aussie to outperform in a way, in the sense of not fall as much, because we don't have as much growth, which you just noted is the strongest sector on the ASX yesterday. But you kind of a bit more bearish on the Aussie, are you, or timing-wise is different?
Yeah, so in that early sort of phases of the growth crunch there, then we tend to hold up better. So we didn't have the sort of same size correction that that the US market had in the 2002 technology crunch. I mean, that correction there, and also other sort of growth crunches as well, we sort of tend to come up as well. But in these sort of like a lot of these sort of bearish phases there, we tend to find our lows a bit later, which is pretty interesting. So and so far we've been pretty impulsive off this lower high here. Pretty heavy selling, pretty heavy volumes as well. You can see the volume has really picked up on the way down here, and we're really starting to sort of sell off in a pretty aggressive manner. So that really does. I mean, we've gone down to retest that low almost yesterday within probably 10 or 20 points of the last low there. So again, you might get a little bounce here for a couple of days there, but I think it points to a lower level. Just so there's a few levels to watch underneath that, but yeah, just starting to sort of think here that this might go a little deeper here, a little, and yeah, just had to reevaluate my view on Aussie stocks there. Just looking at some of the cycles there, just we could be the laggard here, and fall a bit deeper here.
Well, that's a good point to just brush up on that 60-year cycle, because it helps explain the other charts that you've brought up.
Yep.
So you've got the Dow Jones 60-year. How's this going roadmap wise?
So yeah, so it's been perfect so far. So basically, obviously, it's from a timing perspective there, it's matched a 60-year cycle pretty closely. Fall in the same windows. It's interesting. It's actually come back to that 2020 high. So it's actually probably hit our first major level there. It's that was probably the ideal target when we're sort of coming off the high there. So interesting, we're already at that. So maybe we go slightly deeper. There is sort of 50% of the range might be pretty interesting, just around 28,000. That would be a good low to reach here in the next couple of weeks. But this market is getting a bit oversold here. It's just so far there's a pretty impulsive move there, Chris, off the high. So it's like 1, 2, 3, 4, 5 weeks, and we're down to the low here. So that's a really quick move. So you normally get a bit of follow through. So something like that is impulsive there. It's pretty, that suggests a bit deeper there. So something around 28,000 might be the look there. So the 60-year cycle made a high low, but a lot of the other cycles in this year are sort of indicating we should, there's a good chance we'll go to a new low. And I think that's likely here. So, but we definitely already met our first target there. Just might go slightly lower here in the next week or two. But yeah.
Well, that's a good idea, and good to rehash on that, because you've picked up some other charts. Dustin off. This one is now 20 years old, 2002 low. Why is it important, and what are we learning from it?
Yeah, so I just started to look. I started to sort of plan for the low here. So as I say, I think we're going to see a major low in equity markets here. I mean, we talked about the midterm year and the 4-year presidential cycle. Some of the biggest lows come out of those 4-year charts. We had those last week, and I've covered them previously. So some of the biggest rallies come out of the midterm years, and usually out of sort of the October. If you bought October every midterm year and held it for 14 months, I think the Dow averages something like 49% return. It's something phenomenal. So it doesn't happen every year, but it's got a pretty high correlation and some pretty deep lows and some pretty decent bounces come out of those years. So it's just a year where you see big moves come out of. So I was sort of looking through similar cycles in the past there, and yeah, just made me sort of rethink my view here. So this is the sort of Dow Jones. This is the 2002 growth crunch, and you can see there that obviously similar. Our market had a bit of a July low, bounced up into the August, and then came back into early October low. Pretty impulsive sort of move down. Then from there we sort of bounced up into early December, had a bit of a grind, and then obviously made a higher low in March, and then from there the bull market continued. So that was sort of that's what sort of happened with the US equities and the Dow and stuff there. But the Aussie market, the All Ordinaries, was somewhat very different. So our sort of when our July low didn't really matter too much, ended up going slightly lower into August. Had only a small rally up into August, and then it got a bit of a crunch into the October. But from here, the bounces were pretty meager. We sort of really grinded here into January before the market sort of fell away into March. Instead of making a higher low, we made a much deeper low there. So two things happened there. So our bounce was probably half of what the US bounced, so we underperformed there, and then we got crunched even harder on the way down here. And so I thought, okay, that's interesting. Sort of tells us here that the Australian market sort of found a low a bit later in the cycle. So this is a very similar cycle. It's sort of got the same sort of 10-year, sort of 60-year, and the 4-year presidential cycle as well. So a lot of similarities with the cycle. So okay, pretty interesting. So when I looked at one of the other sort of similar cycles as well, which was the 92, similar sort of setup here. So we got down sort of May high, lower high in July, a bit of a dip into August, rally up into September, pretty similar to what we just sort of had here, similar sort of time frame, and then rolled off into October. Then the US basically started to rally, made a few high lows in November and January before it just kept going. That was the sort of the bull phase sort of took off after that. So if we look at the All Ordinaries in the same period there, the same things happened again here. Again, we've through the same, this is sort of the same sort of similar cycle there, same sort of, it's a part of the decade cycle. But look at the market bounced here, and the bounces were meager. They were really light there. So that bounce up into the September was tiny, and then we've just gone to a new low. We ground here like another, I thought it was roughly 45 days, which is important sort of Gann time, but it was around 43 calendar days into the low there. So we're a month and a half later finding our low. Okay. And so I asked myself a question, gee, these sort of cycles are telling us here that Aussie stocks could underperform here, might go lower here in this cycle. And why is that? And the question was commodities and resources. And so if we look at our, I put this chart up, I put this sort of chart up actually probably a couple of months ago, but these are the sort of stages of the business cycle, is that, bonds sort of go down first, and then your stocks sort of go second, and then your commodities sort of follow. And that's the order of sort of them turning down. And so bonds have been going, US bonds have been going down for about 2 years now. Stocks have been going down for, over what roughly 12 months, and really commodities only sort of had the peak there sort of 3 months ago. So commodities sort of, when I looked at those previous periods there, it was the commodities, it was the resource stocks, kept going lower after the, generally sort of global equities and US equities found lows. So while the US was sort of bouncing, the stock US, traditionally sort of more equity markets with lower resource composition, they were sort of bouncing earlier, and our market was falling later in the cycle there. And that's because of the business cycle. That's sort of what was indicating to me. So I started looking at some of the BHP, just some of the bigger names. They continue to go down a lot later than most of the other sort of stocks here. And if you look at I think I posted the CRB Index previously. We can see here that it's only just, I think it was June here. So only 3 months ago, we found a high in the commodities index there. So we're really starting to turn down. So this is the last, it is following the business cycle so far. This is the last, that's a pretty bearish flag there, and we've broken down here. We're still starting to see commodities starting to get crunched here. But yeah, it's interesting here because really I think it's actually the perfect setup, Chris. It's actually sort of setting up perfectly for this cycle here, because really the big concern there is obviously inflation here. So if the central banks can get on top of inflation, if inflation eases there, then really equity markets can get going big time. And if inflation does hang around, we've seen before in the 70s and the 40s, you can still have pretty decent bounces in the markets as well. So you can still have a bounce either way, but the bigger bounces come when there's, that inflation disappears or lightens off here. But I'm just starting to see some of, a lot of the inflationary markers are all starting to break down here. So commodities is all starting to break down as well. So that's a pretty positive sign there. And the business cycle is just suggesting here. So just tells me to sort of reevaluate how we're going to sort of trade this low in the next couple of weeks there. Probably might need to be a bit US, global orientated, and a little bit less Aussie orientated. So I'll probably be avoiding commodities and resource stocks for the next 3 months, because I think basically the low that comes in October here for equities, it might be, resources might be a month or two later. It might be November or December there before we see it. Just the cycle just suggests that, and the charts are suggesting that as well. And so we're just going to be guided by them. So the beauty is that we might get a nice bounce in some US based funds, and some tech, it might even be some sort of technology funds as well, might bounce here. So the sector which no one sort of wants to buy here, the growth, could be the best performing sector out of this low. And then we might be able to, if we get a nice bounce, maybe that goes up 10, 15, maybe 20% or something in the first couple of months there. Some big moves come out of those midterm year lows in the first couple of months here. Might be able to switch that maybe 45, 60 days after the low, and then take the edge off the tech and then buy the Aussie market into the low there, and then we know we get a bounce there as well. So just need to sort of alter our strategy a little bit based on those previous cycles, but pretty interesting. And definitely everything I see happening in the market. I mean, I mentioned here yesterday, we've talked about Whitehaven Coal. It's gone up basically for ascending trend lines, gone vertical. It's on a classic 13-week exhaustion into the high. That's, Bill McLaren, one of my mentors sort of, talked about these blow off. That's how they end. And so if they're starting to see the energy stocks all starting to cool there. So a big move down in coal stocks there, big moves down in oil stocks there. So if the oil price and all those sort of energy prices starts to subside, that's good for inflation. That could be really good for markets as well. So, I mean, look, the inflationary sort of thing can hang around for years, but if we want to sort of see a big move into the end of the year and a big move next year, just remember that sometimes these inflationary story can take many years to play out. So it might, we might get some easing in inflation for a while, and that'll be pretty positive for equity markets here. So just, to me, it feels like all the pieces are finally getting in place. The market can come up another 3 to 5% here. Everyone will be in absolute panic. No one will basically be wanting to go near equities. Everyone will be talking about full-blown recessions, and everyone will be scared to buy into equities, and that'll be perfect time to buy them when no one will be talking about tech stocks rallying 20% into the end of the year, or possibly rallying 30 to 50% over 14 to 18 months. No one will be thinking that. that's the cycle's suggesting that, which is pretty interesting. So yeah, but all the pieces are actually starting to, at least move into the right sort of position. So yeah, just gonna be patient here for a couple more weeks, see something a little bit deeper, and yeah, this could be a really interesting fortnight ahead. Yeah, just interesting to watch some of the, see what happens with some of these energy, some of the recessionary sort of stuff. Already starting to see some of the prices in shipping, containers, and all those sort of all those macro costs that have been hitting hard. They're all starting to cool as well. So just starting to see quite a few inflationary markers starting to cool off here, which is a really encouraging sign. That's, much as we don't want super high inflationary periods, just not good for anyone. So it would be better to see that come off here. Like, I don't know if it's going to, but even if it does in the short term there, that'll be positive for equities, and hopefully it does, because that high inflation rate is not going to help those who need it the most, unfortunately.
It's a good point that you make there, that the market can rally and no one's expecting it. But it's also critical to note that you're talking about a 12 or 18 month rally. It's not the first time that it's ever happened in markets, like as you've just shown with the charts. We've seen these kind of moves before, and they can have multi-month, 12, 18 month rallies. What kind of percentage gains can they end up printing in those times, Gary?
Well, I think the average rally, I'll dig some of the research out there, but I think the average rally for the last couple of months of these midterm years can be sort of 20-25% for US equities. And I can tell you the average rally out of the midterm year, October, into the end of the following year, so it's literally a 14-month time frame. So October midterm year to December the following year, I think the Dow has rallied on average 49% of the last 100 years out of that low. That's a phenomenal stat. Yeah, so just need to see something a little bit deeper. Be nice. But yeah, I think another 3 to 5% would be perfect on the US equities. Just see that the next few weeks. See, just wait for the fear to, once they see. I mean, there was some genuine fear yesterday in the market. The first time I've seen some genuine fear. I saw a couple of commentators talking about the index having a 4 in front of it, and just made me laugh. But Jesus, just same suspects. Yeah, and everyone's getting pretty bearish. And I thought, that's why I thought we might bounce here. That's why I sort of cut my positions there. I could just smell the first signs of fear, and that tells me to take a little bit of profit. The next one that's going to be even more fear, and that'll be the time to fill the boots up here. So no one's going to see this coming, but that's usually when it does come.
Well, it sounds similar to when you were talking about the inflation print a couple of weeks ago. When you put the bearish positions on that you're taking profits on now, you were saying that everybody was expecting a lower inflation print. It's just all the expectations were for bullish moves, and that was a strong indication for you that what you were suspecting was a bearish move became more likely, because everybody was expecting it to go up and nobody expected it to go down, and that's where the greater risks come in. So that's kind of the same thing reversed in a way.
Yeah, it's like unfortunately, the retail public, they are. I mean, I hate to be cruel here, but they are. They are like sheep here. It's like these energy stocks. Everyone's gone into those stocks there. I mean, the amount of hate mail I got out of from posting a negative Whitehaven chart. All that did to me was reconfirm that my view. It actually gave me more conviction that I'm right here, because they just told me that so many punters have gone long here at the top here. And that's just classic stuff. It's, Gordon Gekko's, where do sheep go, mate? They go to the slaughter, So everyone's got into the most crowded trade in the market at the wrong time here, and they're going to get slaughtered. And everyone's going to get really super bearish here at the low, and they're going to get out. Classic. So I've been doing this for 20 years. Nothing's changed, Chris. It's why some of the grad traders talk about, even GAN, nothing new under the sun. So classic phrase there. It's just the same things repeat over again. It's human nature. The market's actually, it's you sort of have to do the opposite of how you feel. in markets. So when everything feels like, it's perfect, nothing can go wrong, and it's smooth sailing, that's the time when you should be doing something. Because you're on the precipice of something, because that's usually when everything's priced in. It's a perfect market. Everything is priced in. Everyone's already long. No one left to buy. When the crowd's already in, the longest trade is, there's no one left to buy those stocks because everyone's already set. But then obviously in the same token, when things seem their worst and their gloomiest, and it feels like this, that's the point where that's probably the news is the worst. That's usually sort of when that's usually when you should be buying. So basically that's almost like a crescendo of bad news. So your crescendo of good news is your tops, and your crescendo of bad news is your bottoms. And then so you have to sort of, when you're most scared to buy, that's when you should buy. And when you feel like there's nothing can go wrong, and you're almost too confident that nothing can go wrong, that's when you should be selling.
That's reminiscent of where we're talking about Stan Weinstein's profiting in bull and bear markets, book from the 70s, and it's talking about exactly that, where all the headlines are saying one thing, you got to do the opposite. And I guess when we come back next week, we'll be closer to that date, but it's still 1 to 2 weeks away. Is that kind of the target that we're looking for here?
Yeah, that's right. Yeah, so I've taken probably cut my shorts in half yesterday, a little bit more, just hoping for a little bit of a bounce. Might even, if we get a 2-day sharp bounce here, might even look to put a little bit back on. But really, I'm just more focused on trying to nail this low here now. Just trying to do the work, look at the stocks, price action, just drill right in here now. Sort of have a I'm more than I'm probably 60-70% in cash here now, so I'm just waiting to pounce on these stocks here, the ones I want here. So just reviewing the portfolios, reviewing the stocks, making sure that they're the ones that are going to perform the best out of this low here. Keep just interesting, starting to see a few signs already. It's just so we've got a couple more weeks here. We'll we'll see some really good stuff. It'll be interesting to see what happens with the momentum stocks that we cover on Friday too, Chris, because that should show us a little bit here in the next few weeks as well. So that'll be really interesting to watch what comes up in those stocks the next few weeks as well.
Well, I'm looking forward to seeing what the report does and how you dissect those. And that's probably a good point to wrap there. So thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
If you want to see the videos that Gary's talking about, the Friday series, you can click on the right-hand side there. And then there's also the full playlist where Gary's Tuesday videos, where he's talking about these breakdowns, and also last week where he talked about Whitehaven Coal is also on the right.